Welcome to Real Estate 360, an informative and engaging hour discussing everything you need to know about the world of real estate. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much more. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back. Thanks for tuning in to our Real Estate 360 program, your number one source for all of your real estate needs and education. We're broadcasting from the number one business radio station in San Francisco Bay Area, KDOW AM 1220, the Wall Street Business Network. I'm Tom Wilson, your host for the Wednesday edition of Real Estate 360 that comes to you daily, Monday through Friday at 3 p.m., along with my co-host, Joe Kuchera and Laurie Graymont. Make sure you tune in those days for different guests and different subjects for all the information that you need to learn about real estate. If you can't make the live show, you can catch your podcast on RE360radio.com, and you can catch my programs on TomWilsonProperties.com or on iTunes. If you go into TomWilsonProperties.com website, you can sign up for a weekly economic news on real estate about what's going on in the nation. So you get a nice 1-minute read once a week written by an economist who consolidates all the news that's coming out on that subject. And that's a report you can sign up for free. You can also get access to what products Wilson Investment Properties has available. And you can also certainly send in your questions that you might have or topics that you'd like to have on the future programs. And if you'd like some consulting on real estate planning and real estate advice for investing, you can certainly tune in for that as well. We have in our studio today guest Jeb Henley, who is been a real estate investor for about exactly the same length of time as I have, 37 years. And he's invested in many states. He's invested and been involved in construction and investment deals in commercial and multifam and houses, and has been a broker for almost as long. So it's great to have him with us. I've known him for a number of years. He's very experienced, and I know you're going to enjoy getting some advice and learn about his experiences. Jeb, welcome to the program.
Thank you for having me.
How did you get your initial interest in real estate, Jeb? And
the 70s were the first real bounce in California that prices changed, and I watched inflation eat up. I had some inheritance funds, and I watched them almost drop in half while real estate was bouncing in value, and I realized that I needed to change my investment strategy from stocks and bonds into real estate, and I was able to jump into property and learn about both income property and just residential property at a nice time when you could buy property in the $60,000-$70,000 range. So you weren't risking a huge amount of funds, but you had nice rent, and the properties had good returns back then. That was before we got into negative cash flow.
And you're talking about in Northern California, or?
Right. I was born here in the Bay Area, and so I was born in Palo Alto. So I know the Northern California market extensively, and that's been where I've seen all these changes, both here, Santa Cruz to Santa Clara County, from the change from the defense industry here to the high tech, where we've got a whole different hardware and software industry that we didn't have when I was growing up. And you saw that from the ground up.
Indeed.
Yeah.
Yep. And how did those initial investments do? You got in kind of at a time when interest rates were rising too, so that was an interesting.
Right, and I learned both. I built a couple of spec houses that were out looking at the ocean and are now worth in the millions. But when interest rates were at 18%, they just about took me down. So I've been through 4 distinct cycles now, and I have much more respect for wanting to have holding power at my age rather than taking inordinate risks. So I'm always having my eye on the prize and always making sure that I've got a parachute to make a safe landing.
Folks, it's starting to look to a lot of folks, I think, like this is everybody's doing it, so I better get on the bandwagon too. But we'll talk about that a little bit later. Huh?
The bubble question that keeps coming up. I'm sure people ask you the same thing.
Indeed. So what was kind of the next phase in your real estate investing when you had to back out of some of those initial ones?
Well, what I learned was that really it is about holding power and making sure that you don't make bets that you can't keep. And so that was why after the 1989 earthquake, I went to Austin, Texas, and bought 3 apartment buildings from the RTC. And the idea was to have straight cash flow investments. I wasn't really banking on a huge appreciation curve, but what we were able to do was just be lucky that we were buying properties at that point at 20 cents on the dollar, and they went back up almost to 80 cents of value, and then eventually to full value. I'm not sure I was that skilled, but Austin, Texas, as everybody knows, is a great town, and I love Texas. I think just Dallas and those towns are excellent locations and always will be. But Austin at that point was undervalued, and that tech economy was just coming in. They were just building a couple of chip facilities. So it was heading more towards hardware, and that town transformed, and so I was able to double rents, double the values of my properties. And that was a real learning curve for me of how to do that at a large scale, so I was able to make quite a bit of money.
The high-tech transformation certainly grew Austin. I get folks asking me frequently today about how I like Austin. I said, well, I'd love to live there, but it's the most expensive city in Texas. It's got because it has Silicon Valley-itis.
It does. It also, these are the kinds of things that you learn when you're there. The reason I sold my holdings was that the property taxes are 4%, 4 to 4.5%, and that eats up a significant amount of your net operating income.
Yep. Indeed. It's certainly a nice town, but it doesn't tend to cash flow as well as other areas in Texas, as we know.
Right. It's just something you've really got to be very, very careful in Austin. Usually, people are ending up in the worst sections of town, and that's not a good way for an exit strategy. So, again, I always like to know going in what is my best case, and then know how am I going to sell this asset on the way back out. So that's a lot of what concerns me is that the guys who are now jumping in, flipping properties, thinking that it's easy. It's very easy to buy, as you know, and where it really is difficult is the sale moment when you're able to actually get an escrow closed, because you have to hit appraisal, you have to hit your property condition, and you've got to get your lender appraisal through. It's quite a number of hoops that I think a lot of investors are underestimating the difficulty of getting in and getting out at a significant profit.
Back to your experience cycle, how did you pick Texas when you decided to exit California investing?
I saw that the main areas that were depressed were Phoenix and Louisiana and the Oklahoma, and I looked at all those markets, and Texas had the best infrastructure, great roads, schools, and population, and an educated workforce, and that made all the difference. So you've seen San Antonio, Houston, Dallas all go through the roof. It wasn't just Austin. And I looked at Corpus Christi, but it was just a little too small. So there's basically a city needs to be about 1 million or more to really be investment grade.
That's always been my rule of thumb. I like to have enough critical mass to have enough breadth of economy.
Absolutely. And you have to have a city that's got a college, a university system, preferably more than just one or two, but that gives you your educated workforce, which then drives the economy.
One of the things, in addition to the rent ratio dropping with time, that had me exit from Silicon Valley was that I realized how many eggs I had in one basket here, and how much it was affected by a singular economy. Now, indeed, our high tech is a lot broader than it was before, 30, 40 years ago, but it's still dominantly technology-based corporations, and they tend to to track NASDAQ a bit. So you've got these the cycle that goes up and down. That's what happened, I think, eventually to Austin, even though high tech is only the third largest employment sector in Austin. It's the most volatile, so that's why it tends to go drag up and down, unlike San Antonio, Houston, Dallas, that have a much broader based economy, and they aren't quite as cyclical.
Absolutely. And I think a lot of people in the Bay Area are wanting to be investors here and be able to have that proximity. And the problem with proximity is that you're tying yourself to the rise and fall of, let's say, Google or Pinterest, is the Twitter, any of the new names that you're talking about. And the problem with playing the equity game, as you've seen, is that you can get clobbered very quickly, and that has a risk to it. So that was the piece that I wanted to tell people. You and I have seen at least 4 cycles where there's been a rise and fall, and a lot of people have forgotten that the Bay Area dropped 40% 4 years ago, and that's not to say that couldn't happen again. And there are some risks on the horizon, which is interest rates can change dramatically, and it can change quickly. And I think we've got the potential for inflation coming up, and that real estate as a hedge for inflation is something that people do need to consider. But I think that the key piece is having cash flow properties that are going to be able to withstand a long hold time or short hold time, because if you're in negative cash flow, you can't sustain the hold. They're called alligators for a reason. They're chomping at you, and it's very painful. It's
amazing how short memories can be. This recent downturn and cycle we've been through has made so many headlines and so emotionally impressive that it has kind of made people forget that it was not that long ago that we had our last cycle. And this wasn't the first time we've gone down. We didn't go down this much. But in '89 that you mentioned before, my goodness, people don't understand how tough that was in post-'89. We dropped a good 25% here in the Bay Area, which maybe was not as bad, but that was painful for those of us that were holding. Fortunately, I was not leveraged very high, so I rode through it okay. But in '89 we had the Japanese and Asian stock markets took a hit, and we had a lot of dollars coming in from there. We had the Loma Prieta earthquake that happened, and we had the Department of Defense. The Cold War ended, and the wall came down. We had all 3 of those events happen within about 90 days, and so. It was. I was amazed we only went down by 25%. So we're talking with Jeb Henley, who's had 37 years of experience in investing. He's a broker here in the Bay Area, but he's invested in many states. When we get back, he's going to chat with us about things that he's learned. So stay with us here on KDOW 1220 AM. We'll be right back.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back. We have with us special guest in the studio today, Jeb Henley, who's a 37-year experienced investor, broker, experienced with commercial, multifam, single family, and watches economics world very carefully. He's learned over the years that you better watch the timing and of real estate and all the events that happen so you can make intelligent decisions, because it's a lot of moving parts. Jeb, what states have you invested in?
So I've traveled to almost all of I've been extensively involved in Florida. I've looked at both North and South Carolina and through Georgia, and then through the South. I did, because the car factories were changing their location over the last 10 years. I watched those economies and chose not to be in Alabama and Mississippi and Louisiana for a variety of reasons. But Texas has always struck me as being the prime state that's going to be driving America. And that has proved to be accurate, and I think that for a variety of reasons we can discuss, that's going to actually unfold at an even stronger pace through the next 5 years. And I've also spent quite a bit of time in the Arizona area, which has had 2 crashes to the 4 that I've seen here in the Bay Area, and I think that it's now climbing back out. I have, I think, 25 holdings as of today in the Phoenix market myself personally, and I like that because they're underpriced and they have good upside potential and good income. Generally, we're getting 10 to 14 real cash-on-cash returns on those properties. You can't beat that. If they never come back, so be it. I make 12%. If I double my money and make 12%, I am that smart.
In good times, we all look like geniuses, don't we?
Yeah, in a rising market, you do. And the key is, this is my third go-round. Can I asset, accumulate, and hold? And actually get to the profit or the passive income. And so I'm much more diversified. For a lot of people that know me, I had Dell Computers server building in Austin, Texas, and that was great for 15 years. They paid me $50,000 a month. It was a cashier's check, and it went into my checkbook until the day they didn't pay me, and that was at $1,000 a day. I held on for 3 years, but it was leasing a single-tenant building was a lot more difficult than anyone could possibly have ever led me to believe, and it was, of course, the tech crash. So it was a confluence of events. But I've just learned to be very cautious, and because I've seen a lot of investors who had a lot of Kmart buildings, for example. When Kmart went bankrupt, they lost everything. So it's a more complicated process than I think a lot of people look at real estate and think, well, how many moving parts are there? Well, there's a lot. You really have to have a team of people who are going to get a multitude of things done. So whether it's flooring or roofing or plumbing, and knowing what those bids are going in and managing those is really the skill. And having a team is off bandied about, but really being able to have people that you can trust with that information. For example, we're buying land and building in Phoenix, so we've got engineering staff, we've got architects. Knowing those people and what their skills are and what their costs are is part of what is an essential piece of what your skills are going to be in real estate, and hence your profit. So it's really deciding what area and field is going to be your expertise, and then what you're going to be able to change the value on a piece of property, both just from buying it or knowing to buy it, or in our case, we're buying land and we're putting in entitlements. And just knowing what that is, what's the right segment of town, and what's the right price to buy and then sell is that's the skill, and that's what we've learned over all the years of winning and losing, right, Tom?
Right, and you accumulate and acquire certain skills, but you always need new team members that are experts in the areas that you aren't so strong on. So, for example, if you and I go into a new city, even though we have a lot of experience, I don't think you any more than I would dream of doing that without finding some local experts that know that particular market and what's unique about it.
Absolutely.
We have with us in studio today Jeb Henley, 37-year experienced investor and broker in multiple states and multiple kinds of real estate. It's great to have him with us and to learn about his experience. And when he come back, we're going to talk a little bit about some things he advises not to do that maybe he had some experience with the tough way. KDOW 1220 AM. This is Real Estate 360. We'll be right back.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back. We have in the studio with us today Jeb Henley, a very experienced investor and broker, and he's sharing with us what he's learned over watching and being involved in, not just watching, 4 cycles of real estate and lots of different kinds of real estate. Let's start talking about things you've learned and what you would advise new investors and not so new investors. What are some of the things you've learned the most?
I think for everyone, knowing that when you're looking at yesterday's news, which is what all this real estate data almost is, either 6 months or 3 months old. So you're watching data or you're reading data that's essentially out of date, and that will have some momentum past your due date, but you're going to end up with a misconception of the market that can bite you rather hard in a way if you've got an empty spec house or you're missing the market. So again, just when you're doing your investing, know what your risk is and what your risk tolerance is, because I think a lot of people are jumping in now assuming a certain meteoric rise that may or may not be proven. Now, if you're a mile from Google, I guess you could probably do almost anything, but for anyone, if you're in the South San Jose or you're over here in Fremont, it's a whole different market and different market cycle that's very different from what you're interpreting. So
the market's really thousands of submarkets.
And then remember the funny statement that all politics is local and all real estate is very, very local. You really need to tattoo that on your wrist and look at it all the time, because it can vary block to block and also,
price category to price category.
Absolutely. And if interest rates really change, and I'm convinced that they are, that's going to really alter the landscape, especially in California where you've got higher prices. It's going to be much less impact for me in Phoenix on a $50,000 building than it is here at a $500,000 building.
And in Texas.
In Texas, yeah. Texas at 100. So again, I sell houses in Houston. I think I've got 2 in escrow at 65, 75, and 85. Interest rates will have some impact, but nothing like I'm a broker here in California, and I'm selling properties at $600,000, $700,000, $800,000, $900,000. Believe me, a 2-point change really alters all of my property pro formas. So that is something very important to note, and that's that. At some point, we've got enough transitions going on here today in the U.S. government, but also internationally, and I think we've got to realize that interest rates are not guaranteed to be sitting at the 4% and 5% rate that we've got now. That's artificially low, and at some point they're going to have to take the foot off the brake, and that as interest rates change, prices will change. So that's something, again, that people need to look out and go, okay, change is coming. How are you prepared to adjust your market strategy for change?
Yeah, and now we've seen curves in the past. They've been shown to us by friends like Bruce Norris that show that the at least initially, rises in interest rates sometimes don't have much impact on volume, but certainly it's going to have some impact eventually on price.
Right.
Yeah, and so we have times when you've got fence sitters there that have been watching interest rates, and now they're worried it'll go even higher, so you can keep the initial volume going for a while. But it's certainly an indicator that you got to watch very carefully. We have Jeb Henley with us today in the studio talking about things he's learned from his 37 years of experience in real estate investing and as a broker. And we'll be back in just a few minutes here to continue that discussion on advice that he can give to new investors and experienced investors on KDOW AM 1220, the Wall Street Business Network.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Nice to have you with us today. We have friend and experienced investor Jeb Henley in here, 37 years of experience as an investor, 35 years as a broker, multiple states, multiple kinds of real estate. It's great to have folks like this to share with us their experience. One thing is to help keep us from going through some of the mistakes that they have made and I've made, and others are to use your experience to help guide where you go in the future. So we were talking just before the break about the market and how we're got to be more careful now than we were last year. So if we were going to twist your arm to put your crystal ball guess on this, Jeb, where do you think interest rates are going to go? Where do you think volume of sales and price of properties are going to go? And let's say Bay Area to start with, even though that's hundreds of submarkets.
It is, and the key piece that people need to understand is I'm an actual live broker. I have multiple signs across 2 or 3 counties here in the Bay Area. I get calls. I actually show property, and I can tell you that the market actually peaked both in the multifamily market about 4 months ago, and that the general residential market, while accelerating in Atherton and Los Gatos, is slowing, and it's much slower than people would like to believe. So caution is the key. Coupled with that is the idea that there are other markets in other states, and that I think that Texas, where Tom is really a tremendous state that's going to transform even further. Dallas and Houston both vie off between who's got the fastest growth or the biggest job growth. Or it's basically those are the 2 main cities in America. And I sell properties in Houston. Tom sells them in Dallas, and they're both kind of similar single-family residences, and they are doing very, very well.
In fact, a lot of market research firms rank Dallas and Houston as 2 of the biggest emerging major economies in North America over the next 2 decades.
Absolutely. And so what I've been talking about is that the natural gas that's being in West Texas is in excess supply, and they've just now done what I presumed they were going to do, which is they're building trenches and they're putting in the infrastructure to ship that gas to northern Mexico, where they're going to be expanding their production facilities, and all those light assembly and sub-assembly jobs are going to be done in Texas, and that engineering is all going to be jobs, and all the experienced college work is going to be in Texas, and while the light manufacturing is going to be done in Mexico. And I think you're going to find a much bigger synergy from Mexico and Texas, and yes, America, but really the border is really going to be primarily, and then some small portion of it will be Phoenix, which is why I'm concentrating on those 2 states, Arizona and Texas. Those are going to be the beneficiaries of the transition of America going towards a American platform of production and design and manufacturing that's going to be done in the Americas rather than in Vietnam, or, I mean, they'll still be making T-shirts in Bangladesh, but that's not really an economy of scale. Where the cars are going to be manufactured, where things are going to be actually built, is surprisingly going to be in Mexico and in some parts of America, because of the affordability of oil and the social stability that these areas now present.
And political stability.
Yeah.
Yep.
And that's, I know, as chaotic as it may seem today, America is going to be much better over the long period than the Chinese economy and India. Once you think about it, you realize that if you're going to be building a factory that's going to have to be around for 10 years, you're going to want it to be in a place where you know the roads, you know what your energy is going to be, and you know that you've got a trained workforce that's going to show up on a day-to-day basis.
And even though on a daily headline basis we're annoyed about our politics, you look at other economies in the world, and we're still somewhat more stable.
Yes, absolutely. So the key piece, rather than just having today be what not to do, I think what to do is we've been investing in the small multifamily market in Phoenix and in the single-family market in Texas, and I think those markets will continue to be strong. And the third piece that we've added has been condominiums. It's I think that you emailed me last night saying that that the condo insurance is very low. Those condominiums were the worst performing asset for a long time, and as with all assets, every dog gets its day. Condos are really the key piece. That's what we're concentrating on in Phoenix.
They tend to have bigger swings up and down.
Yeah.
So and often they lag the detached market.
Right.
So there's still some opportunities in the townhouse condo arena, as long as the HOAs are sufficiently funded. That maybe if you feel like you lost out on this up wave, there's still areas and there's still types of products where you can catch some of this.
Right. There is still upside in some markets, and that's what investors need to realize is that jumping into a single-family house in San Jose is probably not necessarily all that prudent, but taking a look at some other investment options is there still is some market room up, and it's just trying to realize that everything changes almost on a monthly basis, but certainly in every 3 to 6 months, and that you need to have your plan and be able to adjust your plan quickly because things do alter rapidly.
And we think there are areas like Texas where there's still upside potential greater than areas that maybe are starting to peak out again, like areas in California that have appreciated a lot.
We're seeing rent growth and price growth in Texas and across Texas. I mean, that's, again, San Antonio, Houston, Dallas, and which is everyone thinks the only growth is near Google. Well, that's not actually true.
Jeb Henley is with us today, experienced investor, broker, multiple states and types of products. We've been discussing his experiences and where things are going in the real estate market and how you can capitalize on it. We'll be back in just a moment. To wrap up, this is Tom Wilson with Real Estate 360, KDOW 1220 AM, Wall Street Business Network. Stay with us. We'll be right back.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Thanks and welcome back. We have the benefit today of having Jeb Henley with us and to hear what he's learned with 37 years worth of investing experience in multiple kinds of products and states. Great to have him with us. For a quick wrap up here, Jeb, tell us, a lot of people I find ask, should I be investing in passive or should I make some of these quick bucks flipping? What would you tell them?
Well, I'd say if you don't have a day job and you really can spend 12 hours a day and you've got your team and you know how to do a flip, then great. But if you're just coming at it, I had a client call me last week saying, I've got $100,000 in my credit line in my house, and I heard I can be doing 10 flips a month. And I just about dropped the phone. I thought, who is telling you this? And you're going to be not just losing money, you're going to be losing borrowed money. And that's unfortunately kind of where we are. That scares me is that people they're not just betting capital, they're betting borrowed capital, which is my family owned half of downtown San Diego, Tom, in 1928. We lost everything. We had one of the largest houses in California, and they lost what would now be almost trillions because they were leveraged. And when leverage will make you, it will break you. And that is really the lesson people need to know, that when you bet the ranch, you really want. Now, I'm flipping condos, but they're a 12 to 14% return. If we never sell them, we're fine. So be very, very careful out there with chasing that rainbow.
Yep. Especially as times change with the economy. Yeah. Jeb, how can if people want some advice from you, and how can they reach you?
I like using the phone, and I know a lot of people don't understand the clarity of that instrument. It is really the prime way to communicate, and it is not Facebook, it is not Twitter. It is talking to someone on the phone where you can banter back and forth and have questions and answers. My phone number is 831-419-4200, and it's Jeb Henley with Equity Transitions. It's called Equity Transitions because I've moved money from various markets, whether it's Sacramento, Stockton. Every market has its upswing and downswing, and right now, of course, I'm in Phoenix, where I think it's the right time at the right place. But that'll be done in 3 months, 3 weeks, 3 years. I don't know. These markets all change very rapidly. So 831-419-4200, and it's really just trying to come up with a plan for each investor and what their portfolio is and what their long-term goals are. So if people want to, I'm glad to talk and try to clarify their goals.
Thanks, Jeb, for being with us today. And go on TomWilsonProperties.com and sign up for a weekly economics newsletter on what's going on in real estate, a nice 1-minute read. And also there's a report you can get on how to choose the best metro and type of product to invest in. And I'm also available for consultation at any time you'd like to connect up with me. So it's very nice having you with us today. We'll have another great program next week with another guest. Jeb, thank you for your time. Thanks for being here in the studio with us. Remember that the only thing that matters is what you do next. So we'll look forward to seeing you on the next program here on KDOW, 1220 AM, the Wall Street Business Network. This is Real Estate 360.
You've been listening to Real Estate 360 on AM 1220 KDOW. For more information on today's program, visit RE360radio.com. That's RE360radio.com. AM 1220 KDOW.